This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
So, having looked at the cost of equity and the cost of preference shares, before we go through and look at a full weighted average cost of capital calculation, we're now going to go through and look at the cost of debt. Cost of debt is probably the most complex of the three costs to work out. So it does take a little bit of time to absorb the knowledge, but keep practicing the questions and you won't go too far wrong within the exam. Okay. So when we're going through and looking at the cost of debt, we're going to think about it in a similar way to what we did previously with regards to working out the cost of equity, the cost of preference shares, and again using what sounds a bit strange as the dividend valuation model. And the reason why I say it's strange is because we're not paying a dividend, are we? Okay. This form of finance doesn't involve dividend payments. It involves interest payments, doesn't it? Okay. But it follows the same principles. So by that, let's just go through and again draw up a timeline similar to what we had earlier. Okay. So what you've got there, T0, 1, 2, 3. Remember, we're going to go through there and look at our debt and just assume that it goes on forever and ever into infinity before we then complicate it afterwards. And what you've got there is that every single year, T1, T2, T3, we will go through there and pay interest, won't we? Okay, so maybe we've taken out a bank loan and we pay 10% interest. So if we've borrowed $1 million, then we will pay, would it be 10% of that 1 million? That's 100,000, isn't it? Okay, 100,000 interest payment every single year. However, the key difference that we have between debt and equity is, remember, the problem with equity is that the dividends are not tax deductible, are they? One of the benefits of taking out debt finance is that we have interest payments which save us tax, don't they? So if we assume that we have a tax rate of T, then what you've got there is every single year you have a saving, don't we? A saving of the tax rate multiplied by the interest that is paid. So essentially what you've got here is that you have your interest payments, and then you have, is it the tax savings on that interest payment? Okay. Again, we're going to go through there and assume it carries on for now, forever and ever into infinity. Okay. But that is the principle that we are going to go through and follow. Again, what we're going to have to go through and do, similar to earlier on, is we need to work out that cost of debt. So we need to discount those future cash flows back to present value at the cost of debt to give us the market value of our debt if it's tradable, or if you like, the book value if it is non-tradable debt. So when you're working out KD, the fundamental calculations come down to working out the IRR of the future cash flows. Again, IRR sounds a little bit scary, sounds a little bit intimidating, doesn't it? Don't panic or stress too much. There is only one scenario within an exam where you would actually be asked to do the full IRR calculation. Other than that, all the other scenarios that you're going to be confronted with involve, like we've seen already, remembering a formula and applying the information within the question to that formula. Okay, so the key bits I want you to take for the time being before we start looking at non-tradable debt in the next session is that a company will borrow money and it will therefore pay interest. When we pay interest, say at 10%, we then save tax, don't we, at whatever the tax rate may be. So if the tax rate is 20%, if we pay interest at 10%, then we will save tax at 20% on that interest payment, won't we? Okay, and then to work out the cost of debt, we're going to use the IRR of those future cash flows. That's all I want you to take on board for now. As we said, have a go at the next few videos and see how we go on. You might need to go through and repeat them a few times just to make sure that it does go through and settle. Very best of luck on this.